guys, welcome to Unison's weekly fundamental analysis. So first of all, as usual, let's look at the dollar. So the US May non-agricultural is disappointing. The dollar rose slightly on a weekly basis. So the US non-agricultural employment rate increased by 559,000 in May, which was significantly higher than the previous value of 262,000 in April, but still slightly less than the 650,000 predicted by the market. At the same time, data showed that the unemployment rate dropped to 5.8% unexpectedly. The participation rate dropped further. This seemed to further confirm that the unemployment protection measures provided by the US government still affect job hunting activities to a considerable extent. However, as some regions start to end or reduce related welfare subsidy measures ahead of schedule and at the same time encourage job hunting behavior, job hunting needs may be recorded later have to pick up. So the next data in June will be particularly eye-catching. So overall, this report may look weaker than expected. Of course, the Federal is unlikely to interpret this phenomenon, especially the decline in the labor force participation rate, as substantive progress in narrowing the labor market gap. Therefore, it is not surprising that the prices of financial assets have risen slightly because on the surface the possibility of reducing the scale of debt purchases in the short term is reduced. Okay, coming up next, let's look at the euro. So the European Central Bank will maintain policy easing this year. The survey shows that the European Central Bank is not expected to adjust the overall scale of its asset purchase plan at its 10th of June meeting, but will begin to reduce the purchase scale of its epidemic assistance program later this year. The survey also shows that inflation risks are biased to the upside. Okay, so as the economy is recovering and price pressures are rising, calls to leave emergency debt purchases have also increased in recent weeks. However, several members of the European Central Bank have indicated that it is unlikely to make a decision to cut debt purchases at the 10th of June meeting. The outlook for economic growth in the Eurozone has been revised upwards. The average growth rate for this year and next is generally expected to be 4.2% higher than the 4.1% forecast last month. Christoph Will, senior analyst at the Commerzbank, said, with the gradual relaxation of epidemic prevention restrictions, economic and social life will resume in the next few weeks. We expect that once the lockdown ends, the economy will recover strongly, just like the summer of 2020. Okay, so coming up next, let's look at the Japanese yen. The Bank of Japan is unwilling to shrink policy, and the yen is expected to remain weak. Under the combined effect of the most dovish central banks in developed countries and companies keen to use cash overseas, the yen has become one of the world's worst performing currencies this year, and this weakness may continue for some time. Since the beginning of this year, domestic and foreign factors have jointly pushed the yen-dollar exchange rate to fall by 6%. Unlike other major central banks that have begun to face inflation risks and are considering withdrawing emergency stimulus measures, the Bank of Japan has not only been struggling to deal with deflation, but it is also obviously reluctant to publicly imply any reduction measures. Japan is also slower than most countries in pushing the domestic population to get a COVID-19 vaccine and return to normal. Its economy is shrinking, and the absence of foreign tourists may mean that the 2020 Tokyo Olympics, which have been postponed to this summer, will not bring real impetus. Alright, coming up next, let's look at the Aussie dollar. So the Reserve Bank of the Australia stands still, expecting a weaker Australian dollar. Okay, so the monetary policy statement stated that Australia's economic recovery is stronger than expected and is expected to continue. The RBA's core economic growth forecast is that the growth rates in 2021 and 2022 are expected to be 4.75% and 3.5% respectively. Furthermore, the statement stated that progress in reducing unemployment was faster than expected. The unemployment rate fell further to 5.5% in April. The number of job vacancies is currently at a high level. By the end of the year, the unemployment rate is expected to further drop to about 5%. So the statement says that the committee is still determined to maintain highly supportive monetary conditions to support Australia's return to full employment and in line with the target level of inflation. The Federal will not raise interest rates until the actual inflation rate continues to stay within the target range of 2 to 3%. To achieve this, the labor market must be tight enough to generate wage growth far above current levels. This will have to wait until 2024 at the earliest. Alright, so lastly, this will be the forex calendar for next week. So for traders who are going to trade whenever there's news, please put your stop loss as the market will be volatile. Right, so that's all for today. Thanks for watching.